In 2026, $10,000 will feel smaller than it sounds. Not because it's useless, but because the world around it has changed quietly, mathematically, and without asking your permission. The mistake most people make isn't starting with too little money. It's building a portfolio for a world that no longer exists. Tonight, we're not talking about shortcuts. We're talking about structure. Because a $10,000 portfolio doesn't fail from bad luck. It fails from bad assumptions. Why this matters now. For most of modern history, building wealth followed a simple script. Save, invest, wait. Markets grew. Inflation stayed tame. Time did the heavy lifting. That script is breaking. Debt is higher than ever. Governments are borrowing faster than they can grow. Interest rates are no longer background noise. And markets are reacting to forces most investors don't even see. In 2026, the question isn't, how do I invest? It's what kind of world am I investing into? Because $10,000 placed well can compound quietly. Placed poorly, it just treads water while risk piles up underneath. Step 1. Understand what $10,000 actually is. Let's start with an uncomfortable truth. $10,000 is not capital. It's optionality. It doesn't buy control. It doesn't buy safety. What it buys is exposure. Every dollar you invest is a vote on how the system behaves next. Growth or stagnation. Inflation or stability. Order or volatility. Most people treat a portfolio like a collection of assets. Professionals treat it like a system of probabilities. So before choosing where the money goes, you choose what it's allowed to do. Step 2. The core. Boring on purpose. Roughly half of a $10,000 portfolio should do one thing only: survive. Not outperform, not get exciting. Just stay standing while the world does whatever it does next. That usually means broad exposure to productive businesses, not stories, not trends. Companies that earn money across countries, currencies, and cycles. This portion doesn't need constant attention. Its job is to move slowly, predictably, and relentlessly. People underestimate how powerful boring becomes when chaos increases. Step 3. The growth layer. Where risk is allowed. The mistake isn't taking risk. The mistake is taking it everywhere. A smaller slice of the portfolio can chase growth, but with rules. This is where you place bets on change. Technology adoption, energy transitions, shifts in global consumption. But here's the catch. Growth assets are fragile. They don't break gradually. They snap. That means position size matters more than conviction. If one idea can sink the entire portfolio, it's not an investment. It's a liability. Step 4. The stability layer. Most people ignore. This is where portfolios quietly fail. Cash-like assets, short-duration bonds, instruments that don't explode when rates move. They're not exciting. They don't trend on social media, but they give you something priceless. Time. When markets fall, liquidity is leverage. It lets you wait. It lets you move. It lets you avoid selling good assets at bad moments. In unstable systems, flexibility beats optimism. The math nobody likes to talk about. Let's pause and do the math most videos avoid. A $10,000 portfolio earning 7% annually becomes about $19,700 in 10 years. At 10%, it becomes about $26,000. Now subtract inflation, subtract taxes, subtract mistakes. Suddenly, returns matter less than consistency. Avoiding large drawdowns becomes more important than chasing big wins. The real enemy of small portfolios isn't low returns. It's volatility combined with impatience. Popular belief versus reality. Popular belief says, Be aggressive when you're young. Reality says, be precise when you're small. Large portfolios survive mistakes. Small ones don't. Every decision has more weight. Every drawdown takes longer to recover from. Every emotional reaction costs more. This is why discipline scales better than intelligence. Zooming out, what this portfolio is really doing. A $10,000 portfolio in 2026 isn't trying to beat the market. It's trying to align with how the system actually functions. It assumes growth is uneven, inflation is persistent, volatility is structural, liquidity has value. It doesn't rely on perfect forecasts. It relies on resilience. Because the future won't announce itself politely. It will arrive through policy shifts, market stress, and sudden repricing. The goal isn't prediction, it's preparation. The final question. So here's the question that matters. When the next surprise hits the system, and it will your $10,000 be frozen in the wrong place or positioned to respond? Because in the end, portfolios don't grow from confidence. They grow from understanding how money actually moves. And most people don't lose because they're wrong. They lose because they never asked what game they were really playing.